Hello everyone, my name is Dihan Banschai and welcome to the first episode of Finance, Facts and Fiction. So today we're going to discuss a topic that gets many people confused. Is it easy to make money on the stock market? Well, I will try to convince you that it's not that easy and that these get-rich-quick schemes are nothing but most often just a scam. So in the upcoming videos, I want to start building a foundation and build our understanding of finance. So let's get started. Have you ever seen this prank? You're walking to town and suddenly you realize some money is lying on the ground. You're walking towards the money. The moment that you're trying to pick it up, you notice that there's a string attached and some children yank the money away. It's funny because the person thinks they've found an easy game, but it's just a trick. In finance, this scenario is like finding risk-free profits. Spoiler alert, they don't last long. And in today's video, we're going to dive into the concept of no arbitrage, why free money rarely exists in financial markets, and how this principle keeps things fair. So what is arbitrage? Arbitrage is when you buy something at a low price and sell it at a higher price, making a profit without taking any risk. It's like finding a hidden treasure or that money on the street, which no one else has noticed, and you're able to pick it up. Sounds amazing, right? So here's a simple example. Imagine that there's a new gaming console. Now, in town, one store sells it for 300 euros, while another sells it for 320 euros, just across town. Now, if you buy the console at the cheapest store, you can buy it for 300. And then if you race across town, you can immediately sell it to someone else who was going to buy it at the more expensive store, and you pocket the difference of 20 euros. So, but here's the thing. If you're gonna buy that product at the cheaper store and try to sell it at the higher store, what's going to happen is that because you're buying the product, the price at the cheaper store will go up and the price at the more expensive store will go down. And if you repeat this exercise, there will be one point where both prices in the cheaper store and the expensive store will be the same. And your arbitrage opportunities will quickly disappear. And here's the catch. It's not risk-free, this strategy. You're assuming that you're going to find a buyer who's willing to buy it at 320 euros. And you're ignoring cost. For example, you're ignoring the cost that it takes you to travel between stores. Maybe you take public transport, your car, but also you have to spend a lot of time buying the product at one store and selling the product at another store. So you also have a cost in the time spent on the strategy. And most importantly, you also want to wonder, why are you the one exploiting this trade? Are you the only one with this knowledge? And what happens if others notice this opportunity too? Once others notice this, they'll start doing the same. They start buying at the cheaper store and selling at the more expensive store. And as a result, prices will adjust faster. In the end, prices again will be equal to each other. So this is no arbitrage in action. When opportunities like these exist, they disappear quickly. And two identical assets should always have the same price. Think about it. How often have you found, for example, 50 euros on the street? And could you make a living out of this strategy? The financial market is not just some magical place where money can be made out of thin air. But this may also be a good thing, because this means that when we are trying to buy or sell an asset on the financial market, then we're also getting a fair price, which reflects all available information. So there's some real risks to trying to arbitrage the market, and let's try to break it down more precisely. Even if you spot a potential arbitrage opportunity, it's most likely it's not going to be risk-free. For example, what are the transaction fees and are these eating into your profits? But also, what are the risks? Are you able to sell them at this higher price or will the price suddenly drop? And then there's this idea that the trade may not last long. Are you the only one who knows about this? And if there's competition, are you the first to arrive at the scene to pick up that dollar bill? And do you have some competitive advantage? Are you in some way better than your competitors? Maybe you live closer to the street where suddenly this bill appears, but that seems to be a highly unlikely situation. Now, on financial markets, there are these traders called high frequency traders, and they do have some arbitrage opportunities that they exploit, but they trade super, super fast, something that we as regular retail traders cannot copy. And finally, we should consider what is called opportunity cost, a topic we'll explore in later detail in another episode. But simply put, for now, the time you spend chasing this deal might be better spent doing something else, like working or studying. With financial markets, you have to ask yourself, how likely is it that this arbitrage opportunity exists and that I am the one that is able to exploit it? Arbitrage opportunities are rare and it's difficult to make a living out of them. So now let's talk about the trading advice from financial influencers. Imagine a YouTuber telling you about a stock that will definitely go up. Sounds tempting, right? But here's the problem. Why do they have the scoop? How is it possible that they identify stocks better than other analysts? The market is full of smart investors and analysts who are constantly looking for good opportunities. If a stock is overvalued, it's likely to be discovered and corrected quickly. The no-arbitrage principle ensures that prices reflect all available information, and also the information from YouTubers. Now, if they really have the scoop, why would they share the secret with the world? Even if this stock is such a great deal, why aren't they buying it themselves? Or why are they sharing this information and not buying even more of the stock? This is the same as a YouTuber telling you where to find a 50 euro bill on the street, but not able to pick it up him or herself. The likely reason is that the YouTuber already acted on it and now they're profiting by selling this idea. Or they're making money from telling people about these opportunities, and that money is worth more to them than the money that they earn by buying simply that stock. But if that's the case, then there must be some people who also lose on this advice. Now, there's also this notion about how fast markets react to news, and this is called market efficiency. Once the news is widely shared, the stock price should adjust. By the time you act on it, no profits are left. And this will be especially true for YouTubers with many followers who all start to try to find for this arbitrage opportunity. Now, lastly, you also want to consider the cost. Frequently trading based on these tips means high transaction fees, which can wipe out any remaining gains. So trading advice that promises easy money is often too good to be true. Now, the no arbitrage principle ensures that markets stay fair and efficient. Prices reflect all available information, making it tough to find these easy profits. So if someone is telling you that there's a 100 euro bill or 50 euro bill lying somewhere to be picked up, try to be skeptical about that advice. So what has science to say about these trades and these advices? Is it really that bad to follow advice from friends and neighbors or influencers? Now, hopefully the results should come to no surprise to you by now. One common behavior in financial market is herding, where people follow each other's trading decisions without fully thinking them through. You might copy the portfolio of your neighbor or your favorite YouTuber, believing that they have better information than you do. But here's the problem. When a lot of people do this, it can push up stock prices too high, beyond what the company is actually worth. Remember the GameStop frenzy on Robinhood? People said the stock could only go up, and the buying spree followed. Early investors made a fortune as the stock's price soared, but those who bought it later, expecting the same gains, offered huge losses when the bubble burst. Let's have a look at the GameStop frenzy and stock price. So, in the beginning of the COVID crisis, the stock price of GameStop actually went up because more people were into games than before. And then the frenzy happened where a lot of people started to buy the stock simply to push up the price to an even higher value. And at one point, it even peaked at more than $500. But not long thereafter, the stock price already dropped to just $10. Now, there was a resurgence, but over time, from that highest point of $500, there was this clear decrease in the stock price up till the beginning of 2024. But what this shows you is that while there were some winners who bought early, there are also a bunch of losers who bought the stock at the peak of the stock price. And this is the risk of following people's trades. This shows how overconfidence and group behavior can distort the market, and in this case there wasn't even a free lunch, just an illusion of one for many. Now there's this fascinating recent working paper, so it hasn't been published yet, that analyzes trading advice from financial influencers on platforms like Twitter. I'll drop a link in the comments down below if you're interested in it yourself. But here's what they found. Most advice from financial influencers leads to poorer performance. While yes, it's true, some influencers do give good advice, it's incredibly hard to tell the difference between a good and a bad influencer. Actually, the bad influencers have most followers. Now, following the advice of a bad influencer could mean that you lose about 2% per month on your expected returns. And even if some influencers do get lucky or seem successful, it doesn't mean their advice will work for you. Remember, success stories are visible, but the invisible failures often tell a different story. So making money on the market will involve taking risks. There's no free lunch, and we have to understand the risks that we're taking. So here's the reality. The fact is, there's no such thing as easy money. The fiction is, you can get rich quickly without taking risks. Alright, so next time that you're tempted to follow this hot tip, think twice. Why is that person sharing that information? Investing on the financial market is full of risks, and we want to understand those risks before we take the jump. Otherwise, we might get into big trouble with big losses. Thank you for watching. If you have any questions, please drop them in the comments below. If you like this video, please like, share, and subscribe to this channel, and I'll see you in the next video. Bye!